Perfect. Good morning, everyone. This is Ida, your local real estate agent from Minnesota. I real estate agent for the past, I don't know how many years. I can't even counting. They're like out of my 10 fingers. I might need to use my toes. I am with Coldwell Banker with Gojo Realty. I am a team lead. I do what do you call it? Commercial and residential. And plus, I do manage properties. Today, as you guys know, every Wednesday we come and talk about mortgages in English. If you guys have any question, you can come and ask me, even if you don't speak English and you have a question, I will translate it to Peter. He understands a little bit. I'm just kidding. But we are here to support you guys. And then I will give Peter the stage, and then we will talk about like what we're going to talk about today, and then we'll go from there.
Hello, everyone. I am Peter Jerf with Custom Made Mortgages. We are a licensed mortgage broker in the state of Minnesota. The disclaimer we always give is this is for educational and entertainment purposes. These are not quotes or anything like that. If you want that, give us a call. We can go more in depth. But this is to help, again, educate, learn together. And there's a study that just came out, I think in the last month or two, from a big mortgage-related company, and they said 7% of the respondents said they understood the mortgage process fully. So 93% said there was at least some confusion. That involved people that had already gone through the process before. So that's kind of the whole point of this, is to help educate, answer questions if you have them. I see a question about prediction about interest rates. We do not have a crystal ball. Nobody does right now. But we can get into that and kind of like the different avenues too of where things will look. But yep, so that's me.
Perfect. So to just give you an idea on the real estate part of the business right now, me and Peter, we got a couple of deals right now that our clients end up getting a down payment assistance. And also the seller is paying closing costs and dropping price. There is a lot of stuff is going on in the real estate life right now in what we do on a daily basis. I feel like, am I gonna change to the buyer market? I am not for sure, but it cannot give me that 100% because fall is coming. Usually at this time of the year, I tell people that, you know what, it's a good time to buy. I know it is winter. I know it is going to be this. A lot of people, they don't like moving out of their house in the winter time. But if you are planning to purchase this year, I think might be a good time for you to consider and to look around what's going on in the market. Okay. Minnesota, the way I seen it, properties are out there. We have a closing next week. This actually tomorrow. I'm gonna do a walkthrough. I'll make you guys a walkthrough video, and we have I think 2 or 3 in October. So just be aware of your surrounding, what's going on in the market, what state that you live in, and then we can go from there. So today, Peter will give us a little layout what's going on with the Fed news that just happened or is going to happen. I'm not for sure. I don't listen to those things. Peter always listen them, and he's back of his noise and understand what's going on. I hear it from him because it's too much stuff for me, like you guys, but it's good to aware of what's going on. What is in the country? What is the interest rate? What's going to happen? What is the house market's going to go? And I really need you to understand those things and not worry about, interest rate is high, so I'm going to wait until the house crash. A lot of people, they've been saying that, like me and Peter, we got right now 2 or 3 people that they wanted to buy property on the pandemic time. They're pushing. Now they are ready to purchase. And when the property already like make, the equity went up, I don't know, like might be equal to the home price. So, and then at that time, what was it? Interest rate was low. So if you were not purchasing it at that time, and you should not even worry about the interest rate. Interest rate, you can refinance. We all refinance. I did refinance. My interest rate was, I think it was 6.75. And when interest rate dropped, I went and refinance, and I shrunk the year from 30 years to 15. So with that said, I will leave the stage for Peter. Will give us what's going on. What is, the introduction of what are the financial market? What is the financing market right now? What's out there? Why is everybody's like getting antsy about interest rates, this and that and this? So would you give us some info? I'm gonna no, if you guys tap the screen, tap my screen, because I don't want to put Peter big, then you won't be able to tap the screen for sharing and tap it to do whatever that you guys need to do. If I put him big, and I'll be small, so you can touch my screen to do that. Okay, so you guys will be able to see him. Then I'll put him small like me. So if you wanted to tap the screen, just tap me. Go ahead, Peter. I'm muted.
Okay, fantastic. Thank you for the introduction, Ida. So yes, kind of the theme behind today is one of the big Fed meetings that they do periodically throughout the year. And so a lot of people have been reaching out to us because the market, meaning the public, from everybody from the experts in the industry to regular everyday people like us, there's a high likelihood, I think it's somewhere around like 96% to 99%, depending on who you ask, that the Federal Reserve will be cutting their interest rates today. So it's always a big talking point. People hear that, and the minute they hear the word cut, an interest rate cut, they start thinking, how it applies to them. So if they own a house, they start thinking, hey, can I refinance, get a better rate? If they're, even any type of debt that you're trying to take out, if you're looking to buy, there's certain connotations that go with that. And like Ida said, like financial markets, that's literally, if you think about it simply, it's like a grocery store. A lot of stuff being bought and sold. Also, like we saw with eggs, what was that, a year or two ago, we saw egg prices go way up and then they came back down. That also has to do with supply and demand and basic economics. One of the questions, just to get to the questions and not delay that too long for you, somebody asking farther up in the chat was about where the interest rates are going to go or what the prediction is. So, like I said, the consensus right now is everybody's expecting the Federal Reserve to cut 25 basis points, which is 0.25%. And how that's applied depends on the type of financing and that kind of thing. There's a possibility. There's a few people I've talked to who think that might be a 50 basis point cut, which would be twice as much. So it'd be 0.5% from where their base rate is. And there's also a chance that they don't cut, which means obviously they're going to stay where they are. So a lot of times, especially, this is a very nuanced or is a very deep topic. This is something you could teach. You could literally probably get a degree in and spend 4 years learning about if you really wanted to go in every direction. So it can get very deep very quick. But to keep it simple, the Fed borrows money to the banks, and the banks borrow money to us as the consumers, as the public. So one major misconception is the Federal Reserve controls mortgage rates. They don't. They influence it greatly. If you think about it, like a parent influences their child, but anybody that has kids will tell you that their kids are not exactly like them. Sometimes you have kids that are very much like them. Sometimes you have kids that are very different from them because there's additional factors that come into play. So same thing with the Fed. They will if they cut today 25, to get back to that prediction question, if I had to guess, I would guess it's going to be 25 just because that seems to be the consensus. The bigger part of that today that will influence mortgage rates and car loan rates and credit card rates is where everybody thinks that this is going to end up going, further along. So there's a report that comes out with their meeting today that they'll release going over kind of what they think the future holds in the near term and the long term. They will also come out with something that's called a dot plot, which is just a type of graph where they're showing each of the voting members at the Fed, because it's made up of a group of people, and where they think interest rates will go over the next, I think it's like 2 years. So each one of them has one dot for each quarter. There's 4 quarters in a year, and where they think that's going to go. So that is one big influence. If that shows that all of them think the rates are going to go up, that's going to have a major effect on things. If everybody thinks it's going to go down, we're going to be looking at like how fast do they think it's going to go down, and also how much. And then, like I said, also that other report, which I won't get into because it's a little bit more technical, but kind of where they think this is going to go in the future. So what I would guess, and again, this is a wild guess with the interest rates, is they're going to cut 25 basis points. And again, depending on those comments, because their biggest thing right now is employment that they're looking at. Inflation and employment are their 2 biggest things that they look at. About a month ago, they said that they're shifting from inflation, which they've been the main driver the last few years, to employment. Yeah. So employment data has started to get weaker. If you talk to independent reporters out there that are not tied to the Federal Reserve, they will tell you that the job market is much worse than how the Fed is probably looking at it, because the Federal Reserve, the main thing they look at is unemployment, and there's multiple types of unemployment. The main one they look at is called U3. Mm-hmm. That one is still in the low 4s right now, so which is historically low. Usually that means the economy is doing well, and so that's kind of how they've been looking at it. However, U6, a lot of people will tell you that's more accurate. That is very close to 8%. So what happens over the next few months with unemployment and employment and that whole picture is probably the biggest thing that's influencing mortgage rates, because like I said, it is influenced by the Fed, but also the lenders, they make their predictions on how they're going to price it. Mm-hmm. And then also if people are buying mortgage-backed securities, which directly influence rates. So and the other thing that came up, not to go into too deep here, but a couple years ago, part of the reason why the interest rates went so low is because the Federal Reserve started buying up their own mortgage-backed securities, basically, instead of treasuries. When they did that, the price went up, which makes the rates go down. And so if they start to do that again, which they've said they're not going to, but now there's rumors that supposedly they might be, if they started doing that, that would also help bring it down. And then there's also a spread that it has with, we'll just stay with another type of debt that the government has. And that spread has been very big the last few years. That is starting to shrink. So even if nothing else changes and that continues to shrink, that will also push the mortgage rates down. So even if it gets back to where it normally has been, because usually those stay a certain distance apart, we've been much farther apart. So even if they come closer together, again, I'm trying to keep this simple, but they will, that will help the mortgage rates come down. So in the spirit of that, we wanted to just talk about some of this stuff. And the other question, because I just want to make sure before I forget that, so somebody's asking about 7-year ARMs. So right now, well, to define it, an ARM is an acronym for adjustable rate mortgage. So traditionally, we think of a fixed rate mortgage for a home purchase. Usually you'll do a 30-year term. So it's 30-year term. You make a payment once a month. So there's 360 payments. And your interest rate, whatever you lock it at, let's just say 6.5%. That's what your interest is calculated at an annual basis for that 30 years. It doesn't change. It can't go up. It can't go down. You're locked. So if the interest rates go to 18%, you're still at 6.5%. If the interest rates go to 2%, you're still at 6.5%. An adjustable rate mortgage. So the question was about a 7-year ARM.
Mm-hmm.
There's everything right now. The main ones are 3 to 10 years. A 7-year ARM, that's 7, means that your interest rate is fixed for the first 7 years, or if it's a 3-year ARM for 3 years, or a 10-year ARM for 10 years, it's fixed at that rate that you lock it at. So they're gaining popularity right now, just like they did. A lot of people compare this back to 2007. There were people that got the adjustable rate mortgages. And sorry, let me back up. So I'm getting too deep into this. So for that 7-year ARM or the 3-year or 10-year, whatever it is, your mortgage rate is fixed. It does not change. So if you're at 6.5 and the interest rates go in 5 years, they go up to 15%, you're still at that 6.5 rate. But once you get through that first 7 years, now it no longer becomes fixed anymore. It starts to adjust to the market. Yeah. Now, you want to read through the paperwork and see how fast it can adjust, because there's adjustment periods. It can be quarterly, monthly, yearly, as far as how much it can adjust, where it can go up or down based off the market. So if the interest rates, again, this would be pretty shocking, but if interest rates go up to 15% in 7 years, and you have that 7-year ARM, and you're at 6.5%, it will start adjusting upward. It won't jump to 15% the first month, but it will start to slowly adjust up. I just saw somebody's ARM recently from an old ARM, and their interest rate in about 6 months went up about 4%. Every month it went up about 0.5%, because at that time the interest rates were much higher. So that's the downside to it, and that's the more scary side to it. And some people during the great financial crisis that we call it back in 2007, they got those ARMs because sometimes you can get a better rate with an adjustable rate mortgage. There are a couple small banks right now that are getting significantly better rates with those adjustable rate mortgages. And so that's the pull is, all right, if I go to a fixed rate, maybe I get a 6.5 quote, but if I go to an ARM, I get a 6.125 quote. And the difference in the payment might be $100, $200, $300 a month. The bigger the loan, the bigger the difference in payment.
Yep.
So that is the positive side of it. But again, you want to know all the terms. You want to know what they're basing it off of, what market they're basing it off of. And then you also want to have a plan in place to say, okay, what am I going to do if the interest rates do go up to 15% in 7 years? Am I going to be ready to refinance? Yeah. Because we all think about refinancing like, okay, I'm just going to go do that. But you also have to qualify, because a refinance is paying off an old loan and opening a new one. So if you let's say the rates drop to, and last time the rates dropped, we had this with a few clients, the rates dropped to 3% or even under 3%. We had a few clients that they had a lot of late payments on their mortgage, or their credit score dropped to 500, or they didn't have a job, or they didn't have a job that made very much money, or they had really high debt. There's a lot of things that can prevent you from refinancing. So refinancing also is not a guarantee. You still have to qualify for the loan. There's some exceptions for like government loans where you can do what's called the streamline, where they might not check all those things. They will still check credit. But the one thing they will always check is your mortgage payment. So I always tell people, make sure you always make that mortgage payment on time. Usually you can get away with 1 30-day late, but if you have more than 1 30-day late, it can start getting complicated. And if you have a lot of them, like I have one client right now that needs to refinance to take money out of their house, but they've had 6 late payments in the last 2 years, and no lender wants to loan to them. Yeah. So getting back to those ARMs versus fixed rate. Oh, I thought you were.
No, I'm asking them to tap the screen. So Peter, now when you say that, what, like most of the time, what we do as like what I always tell my clients, if they say that, hey, this lender is giving it to me, just an example, 5%, but this guy is giving it to me this percent, that percent. So for me, what at the end of the day, what do we want? We want our payments to be a certain number, right? And if that can be affordable to us. So even when they get the ARM rate, they can ask the lender comparative of the 7-year ARM and the whatever, the 30 years mortgage. What is the difference on the payment? Is it worth it? If there is like a $200 a month saving, is it worth it for you guys to go on ARM? I don't know. To me, I don't know your situation, but what we always say, me and Peter, when we meet the client, budget yourself. Budget. If you budget a certain, we have right now, we have a client, really an amazing guy. I've been working with him for the past 10 years. Credit built, how he can save money and all that. And, he is doing really well. And right now, he wants to have his payment to be this much because he wants to retire in a couple of years. And he does not want it to work too much. And right now, he's pulling overtime and all that kind of stuff. He's a little bit older guy. But he's stuck. Like, this is what I want. If I don't get it with this, and I'm not going to be buying. So you have to have budgets. You need to make your budget, how this can be affordable for you and for your family. So there is a lot of lenders. We talked about it last week about this ARM stuff. 2008, I purchased property when I was in Atlanta. I think Nick is here. Yay!
Hey, Nick.
He's not in yet. Good morning, Nick.
Good morning, Miss Ida.
How are you?
Give me 1 second.
I'm doing excellent. How are you?
I'm doing fantastic. Welcome to the family back again. We're so thrilled and happy for you to be here on Wednesdays.
Nowhere I'd rather be.
Thank you. So 2008, 2009, when we purchased property, I was in Atlanta. At that time, they were asking people to do what? ARM rate, right? And a lot of people, that there's a lot of foreclosure happen, short sale, pre-foreclosure, you name it. So at that time, what happened? The market was dropped. The reason that it dropped because people has an ARM rates and they cannot refinance because they got laid off from their job. And they were late some of their mortgage, they cannot refinance. So when they say refinance, it doesn't mean that you'll be qualified to just refinance. And that's why I said, do your homework before you get your home key. And that's why we are here to give you the road and what we think it is. You take our information and what you do. You go, you Google it. You can go to ChatGPT and ask those questions. Have some kind of an idea to go far. What I'm seeing the past couple of weeks, I will get client calls me, oh, so-and-so got this rate. So-so got this rate. Because we're talking about rates and I wanted to break it down to you guys. So you call me and say, hey, Nick got this kind of rate and Peter got this. But why I'm getting this? Because Peter, he has his own way of getting that rate because it might be his credit is good. He might put in more money down. There is a lot of stuff. Or he is a first-time home buyer and Nick might not be a first-time home buyer because he's not going to get that rate. But he's putting more money down. His credit might be an 820. He's getting a good rate. or his PMI mortgage insurance is lower. So everybody have what? A different kind of characteristics on your loan. So it's the relationship, some people are good relationship with certain people. Some people don't have a good relationship with that certain person. So your credit matters. So if Peter or Nick can give us, those particular stuff, because we get people come and say, so and so got this and he just closed and he got like 6.2. Why I'm getting 7%? I don't know. I don't know about the other guys or the other family's situation. So if you guys and give us an idea. So in the meantime, the people that who's listening, if you guys are kind, if you guys could copy link and tap the screen, I really appreciate it. There's a number of you guys are doing that right now, but at least how many of you guys I can't even see? Getting old, that's what happened. We have 14 people. And if you do that, that would be good. You just hit my screen. And that's why I put Peter in the whole screen earlier and I drop him. So you guys have an opportunity to tap the screen and push it to at least 5,000 and then do the copy link a little bit more. Go ahead, Peter. I'll mute. Or Nick, one of you guys.
Yeah. So I was just going to follow up on that and finish kind of answering that. So like Ida was saying, your interest rate in general is determined by a lot of things. Yesterday I was talking to the loan officer. We were in a chat with a guy who was not a loan officer. The other loan officer has been doing this for almost 50 years. I've been doing this for a while. And he was asking us, like, what determines my rate? And he joking around saying like this. And the other loan officer is like, and also which direction the wind is blowing. Because there's so many factors that go into it. And then every lender also has their own rates. So, it's not the same across the board as anybody can see. And the other thing to remember, that just to back up, is to remember that this whole industry is one big advertisement. Like, you have to remember that this is not even financial analysts. I'm not trying to anybody with any straight bullets here, but even financial analysts, jobs like that is largely sales, because again, everybody's trying to make money. They're offering a service for money. So you're looking, okay, what is this exchange of goods for? Because that's really what a market is. Market is, I have something you want, you have money, or you have something I want, and how do we trade that? And money has become the universal thing, because I might want to buy some oranges from you and you might only have, apples. And so then you got to get other people involved. So if you come up with a currency, you can just say, okay, an apple's worth $1, an orange is worth $1. All right, we're going to trade dollars. Now I can go buy apples from whoever I want to buy from, and you can go buy oranges from whoever you want to buy oranges from. And we don't have to have what the other person wants. So getting back to like the arms situation, again, to zoom out, because as human beings, we tend to just like get laser focused on what we're thinking about. And we tend to forget everything else, especially when it comes to complex topics that we're not well educated on. And that's not to say anybody's not well educated, but this industry, especially the mortgage industry, there is a lot in it. And I've talked to people, clients, even other loan officers that don't know things, or things have changed, because they do change a lot. There was a guy that I was talking to the other day. He owns, I think, 10 mortgage companies. And there was something about how a loan works that he was wrong about. And he's been in the industry for 35 years. And he's worth probably like $50 million. Very successful, hundreds of loan officers who work for him. But it's been so long since he actually did the actual job that there was something I was kind of surprised that he was wrong about. And I'm like, huh? And then he's like, oh, you're right. And then he realized, I actually don't know what I'm talking about. And again, very successful anyways. So getting to that point is, make sure you know who you're talking to and that they know what they're talking about. Because with this being a sales industry, salespeople are the ones that get promoted. Salespeople are the ones that get hired. Salespeople are the one, if you can make a lot of sales, even if you're a bad loan officer from a financial standpoint, companies will pay a lot of money to you, and they will also pay a lot of money to put your face all over the internet and all over advertising. There's definitely correlation with being good at as a loan officer and getting those things, but it's not direct causal link. So just because somebody closed a lot of loans, or just because somebody's face is all over some advertisement, does not mean that they're all of a sudden the best loan officer. And that is the same thing with the rates, and the same thing with the loan products, whether it's a fixed rate or an ARM. The true answer is that it's complex, and that there are many factors that go into it. So you want to be, if you go to a foreign country that you've never been to, or you go to any type of event that you've never been to, it's nice to have somebody who knows what to do and knows where to go and knows what not to do and what to avoid. And so that's I think the bigger thing you want to pay attention to here, because this is one of the, if not the largest financial transaction of your life. And as clients, from a client perspective, we always want the lowest payment because we're going to save money, right? But the truth is, most people these days, especially in the United States, they think about monthly bills. They do not think about long-term financial success. And that's really, you want financial freedom, you want to set up your kids, you want to set up your family, say, the whole saying about building a financial wall to protect your family. That's probably is not always going to line up with the lowest payment every month. But you also have to weigh that with, what can I afford? In a perfect world, everybody would do a 10-year mortgage, but the payment for that is going to be significantly higher than a 30-year mortgage. And a lot of people can't afford a 10-year mortgage. We had a guy that jumped in here a few weeks ago who was talking about buy your house cash. I think we would all prefer to buy cash. No, as the saying goes, nobody buys a mortgage, they buy a house, and the mortgage comes with it. I've never had anybody call me and say, hey, Peter, I really want to get in debt. How do I do this? So there's, like I said, and so this might already sound overwhelming, what I'm talking about right now. And this is just the beginning. And this exemplifies why you need to go to somebody who knows what they're doing and is also going to be honest with you and transparent with you. I'm a big person on transparency because I don't like to trust people, especially when it comes to my money. And so they should be able to show you and answer your questions for, why is this a better idea than this? Or why should I do this and not that? Or what's your opinion here? And sometimes it comes down to, a lot of times, almost always actually, it comes down to your priorities. One question we ask people is, how long do you plan to live in this house? I bought a house through IDA last year. I plan to be here for a very long time. That's a different game plan than somebody who says, I want to move in 3 years. We might give you a different loan. That ARM, that 7-year ARM, if you know you're going to move in less than 7 years, that all of a sudden removes a lot of the risk factor that goes into it. But if you're like me and you know, hey, I probably want to live here for the next 30 plus years, that's a different level of risk that you want to be able to assess. But like I said, there's so many avenues we can go down with this. So I would look at it more of who's being your guide and can they independently verify that for you? And remember, this is all advertising at the end of the day. And loan officers, realtors, a lot of times, because we get paid when the transaction closes, or we get paid the majority of our income when the transactions close, there's incentives there, and everybody does what's best for themselves at the end of the day. So you want to make sure that you're doing what's best for you and working with people who are going to be straightforward with you. And so the ARM thing, a lot of times as loan officers, they're selling you the product that their company's telling you to sell. I'm not going to name names right now, but there's companies out there that are not putting their clients in the best position possible. And there are lawsuits brewing, many lawsuits brewing, because a lot of people, for instance, refinances, I'll just keep it general. There's a couple really big companies. If you've spent 5 minutes on the internet or on apps looking for anything housing related, I guarantee you've seen their name. All three of these companies, and they dominate the market when it comes to advertising, and they're refinancing people in ways where your break-even point, where you're actually going to break even on how much money you spent, is over 15 years. And they're the same ones that are going to call you in 6 to 12 months and tell you to refinance again and do the same thing. And the reason why it works is because the monthly payment goes down. And a lot of these clients do not realize they are making horrible financial decisions because the only thing they look at, the rate and the monthly payment. And if those are the two things that you're looking at and you're not taking the whole picture into account, you're going to very likely end up in a bad financial position long term. And so, again, it's going to all depend on your situation too, because I have a client right now. She needs to get her monthly payment as low as possible because she's struggling. So that is the number one priority. She can't optimize for long-term financial success because right now she's struggling to breathe and she needs to get her head above water. Yep. But we have talked about this and we have a plan long-term to help get her in a right position, catch her breath, get on solid ground. And then step 2 of the plan is to be able to actually help her optimize her finances. So I know I've kind of went off on a tangent there, but I think it's very important when it comes to finances, mortgages, anything like that. You look at the whole picture. And Ida will tell you that on the real estate side too. Don't just look at the house you're buying, look at the neighborhood you're buying in and those type of things. So, and another just quick note with the rate stuff is also look at your fees. Because there's a lot of lenders right now, again, being sales, having that filter on our mind that they're offering lower rates, but they have all these other fees tied into it that you're paying for. I got a loan estimate from another lender recently that they had a phantom credit that they were giving the client for $2,300 from a builder, but the builder does not have anything on their quote saying that they're giving them that incentive. Yep. So this lender, maybe they made a mistake, but to me, that's kind of egregious because you're a professional. We're supposed to review what we're sending you. We can't just send you something and say, hey, we're giving you this deal or that deal. And then 3 weeks later, oops, we made a mistake. Well, that oops isn't going to give you $2,300. So to me, they're being dishonest. Now, again, it could have just been an easy mistake, but those are the things you want to look for when you interview your loan officer, when you interview your real estate agent. Are they telling you what you want to hear? Or are they actually educating, answering your questions? And so, again, tying this all back to the ARM question. Yes, ARMs are better priced right now. Mostly, again, it depends on the situation. But you also want to compare that to the external. So the market, ARMs are a little bit better than fixed in some regard right now, but also your own personal life and the risk factor. We also have somebody else that's refinancing out of an ARM right now because they don't want that risk. They're roughly 3 years into a 7-year ARM. They want to get back into a fixed rate and they don't want to wait the next 4 years. And they understand the financial markets better than most people. They're well-to-do, but that's also why they're doing it. Because that's one thing that when you get around people that are good with their money, they don't gamble it. They don't hope for just best case scenario all the time. They make smart decisions and they protect themselves. So that's the end of my little speech there on that. So,
well, Peter, I'll jump in quick here. Just to kind of close the book on the ARM, question and the situation.
Nick.
Obviously, yeah.
Hi, good morning, my friend. Would you please introduce yourself, who you are? Because we just met you, some of us.
I can do that.
Sorry.
Yeah, hi, my name is Nicholas Jerf. I am a loan originator with Custom Made Mortgages. I am partners with Ida in business, and Peter is my business partner as well, and brother. We both work for Custom Made Mortgages. So, I've been doing this since the inception of our company, which we're going on 4 years now, which seems crazy because it's gone by very, very quickly. Mortgage loan originator though in the state of Minnesota, and my passion is first-time home buyers and particularly helping minority and immigrant clients. Although I'm happy to help anybody. Regarding adjustable rate mortgages, not to get quite as deep into detail as Peter did, and there's so much that goes into this. Peter could talk so many things that you didn't understand regarding mortgages, and that's why you go to an expert. Ida could talk so many things regarding real estate that you don't even realize this is what a realtor does, and your mind might be swimming, but that's why you go to an expert, because you find someone that knows what they're doing in their field that you can trust, and then it makes your job a lot easier. Peter and I are always going to take our time to explain every scenario to you, like Peter is talking about. But just to take a simpler approach, absolutely an adjustable rate mortgage is an option for you. If the savings is significant, if it's $250, $300 a month, it may be an option for you. We're just always going to talk to you about keeping in mind, right? Whatever the term is, if it's a 3-year, 5-year, 7-year, 10-year, at some point your mortgage rate is going to go up. Right, it's an adjustable rate mortgage. Technically, it can go up and down, but like with property taxes and homeowners insurance, things go up. Things get more expensive. They're not gonna get less expensive on you. So one of the things that we haven't mentioned to keep in mind is, let's say you're in a 5-year ARM. So after 5 years of making that fixed mortgage payment, your payment can go up. You can absolutely refinance before that. We tell people to always refinance before that. But one thing you might keep in mind, maybe you're 35 years old and you're getting into a 5-year adjustable rate mortgage, right? And before the 5 years is up, you're smart, you refinance to a fixed rate mortgage. Maybe the rates went down, maybe they got better, but you're resetting your 30-year term, right? So instead of paying this loan off when you're 65 at retirement age, now you've pushed that back to 70 if you're not able to make extra payments, or if you're not able to handle the higher payments of a shorter term. So there's a lot of things to keep in mind depending on even what your age is. And like Peter mentioned, how long you're going to be in the house. If you're planning on moving soon, then an ARM might be for you, and shorter in the short term. So just one thing I wanted to keep in mind is, you can absolutely get an adjustable rate mortgage, but just to keep in mind all the factors, and one of them being, how long do you want to be paying on your house? When do you want to retire? Because, I know for me, I'm in my 30s now, and I have to start thinking about how long I want to work for. So that's just one thing. But it's an option. I don't want to scare you off it or get too deep, but just to keep in mind, there are a lot of factors that go into it. So I'll kick it back over to you, Ida.
Perfect. The way that you explained this thing, you ate injera, right? How you roll every single of whatever that you have in your plate and you put it in one injera and you eat it. That's exactly how you guys are explaining it. Seriously. That is something that I want our people to understand, or people who is following. I'm really impressed that today, even in my YouTube account, I keep seeing like 12, 13, 14 people are out there listening and making comments. So there is, I think, 20 people on TikTok. We were going up and down, but just write us one, if this is important and this is a good information for you that you are getting from us, for us to know, then we can have our ego up and say, hey, I think we're giving you good information. And if you just don't care, just write to, and for us to see what you guys add. And second, if you can tap the screen, and that we can push it to 25 to 30K, and it will be good. It will help our thing. It can go to a different people's site that they will be able to come and listen our stuff. So interest rate, we talked about this thing, and always on a consistent basis, the ARM rate, that rate, this rate, and thank you so much for describing. Cam, I think she's the one that actually been tapping the screen, and I think Tia or Tina or somebody, they've been tapping the screen since I started this site, this TikTok this morning, almost like 43 minutes ago. And I would like all of you guys to have, I think, tap the screen and share at least for 10 people. That can help the screen not to be stuck on TikTok. I will appreciate it. So another question that came out to you guys, please go over 1099 versus W-2 loan applicable. So that is something that I had a phone call this morning. I have a client who is from Las Vegas. She does Uber and all that kind of stuff, but she's making money, but really not money. When she does the tax, it's totally different. So they told her that she won't be qualified, even for $100,000 loan. So if I would love for one of you guys can explain W-2s, and the other, one of you guys can explain what is 1099, what is the pro and con, and all that kind of stuff. Then I can even capture that video and I will actually put it on TikTok. So who's gonna take what before?
I can go over it. That's fine, or I could start and Nick can finish.
Okay.
So
perfect.
Yeah. So when it comes to 1099 versus W-2, W-2 obviously you work for a company. They take out the taxes, all the different things, and then you get your net pay. So when you come to a lender with that type of income, usually it's very straightforward on how to calculate the income. So you have your base pay. Use that based off the number of hours you work that you're scheduled to work. And again, I'm not going to get too detailed into that unless you guys need me to. But it's W-2 is usually the most straightforward, especially like a salaried employee that makes $100,000 a year. You basically divide it by 12 months, and that's going to be your income. It's very straightforward. If your hours fluctuate and change, or the way that you're paid, like your Ida and Nick and I, where you're commission based. Our income is never the same every month. So then we have to average it. But again, there's still ways to do that. When you go to 1099, 1099 is treated as self-employed because technically you are. If you work for Uber, Lyft, those companies, they don't pay health insurance. If you quit, they don't pay unemployment. They don't pay any of those things. So they don't take anything out of your paycheck. They might take their fee, but they don't take anything for taxes or anything like that. So if they send you a check for 10 grand, you get the check for 10 grand. If you're a W-2 employee, they're going to take out those taxes and everything, federal, state, and all that good stuff. And then you might get a check for $7,500. So because of that, you file usually a Schedule C with a 1099. There's different types of businesses. Schedule C is the most basic, and most 1099 employment, you'll file Schedule C. So what Ida was mentioning with that client is when they file taxes, she probably wrote off a lot of her expenses. So in the mortgage world, we have the seesaw effect with tax preparers, because when you bring your you bring that 1099 income to a tax preparer, let's say you made 100 grand from Uber, they're going to try to get that as low as possible for you. So you pay as little in income tax to the government. But the problem with that is lenders use your tax return to determine your income. So to make up a scenario, just to make it easy to understand, if you made 100,000 from Uber and then you go to your tax preparer and you write off $80,000 in expenses for gas and fixing your car and your cell phone bill and GPS, or all the different things, insurance. Now you wrote off $80,000. Your effective income, or your net income after expenses, is $20,000. Well, if you divide that by 12 months, you're making less than $2,000 a month. So you might say, well, I wrote all those things off because it was nice and I could claim less taxes. But now you're not going to get approved for a loan because the lenders have to treat everybody equally across how they do things. So for these traditional loans that we've been talking about this whole time, they're going to use a tax return to do that. There are private lenders, and this is where, we're a mortgage broker, Nick and I. So we work with a lot of different lenders. We have a pricing tool where you can get pricing from over 250 different lenders. And kind of the selling point with a broker like us is we work with a lot of different banks. So we have access to the most loan programs usually. And we can choose who we want to work with, especially if we have a good reputation. So we can establish those relationships, and lender A might have different loan programs than lender B. If you go directly to a lender or directly to a bank or a credit union, they have their set programs. And usually it's, anywhere from like 5 to 15 different loan programs. They usually don't have, depending on the type of lender and everything else, they are usually focused on a certain type of customer that they're going towards, or a certain kind of area of customers that they're going for. So you might be over here and they're focused over here.
Yep.
It's not discrimination to say, hey, we're not really trying to help these type of clients, as long as they treat everybody the same. So what they do is they just don't offer a loan program for that, or they make it really expensive. So if you do want to go through it, to help you, but it's going to be really expensive. So it's a little getting probably detailed there. So anyways, 1099 tax returns, that's the basic way to do it. One thing that Ida's client could do, and I can talk to her about this after the call, is they could look for a mortgage broker, because there are lenders that we work with that can take your 1099, let's say it's $100,000, and they will allow you to use that 1099, this is $100,000, as your income. And now your income is over $8,000 a month. Now all of a sudden you can afford a lot more than you could when you were at roughly, $1,750 a month, because that's about where the income would be if you were making $20,000 a year, $1,750. Like I just said, you're not going to get approved for pretty much anything as far as housing goes in that regard. The 1099 program, use the full amount. There are also private lenders that we work with that will do it based off the cash flow of your business. So we look at your bank statements anywhere from usually 12 months up to 24 months, and say, okay, how much money do you have coming in every month? And then we also look at how much is going out, or we use an expense factor depending on the type of business, and just say we're automatically going to assume 30% of your profit or 30% of your revenue is expenses. So we're going to give you credit for 70% of that. So with that program, you get about credit for $70,000. Still a lot more, almost $6,000 a month than you're at the $20,000 that you made off the tax return. So those are kind of the main things when it comes to 1099 and W-2. And there's a couple other things like risk factors, but I'll let Nick finish this up.
Yeah, so what Peter is talking about is kind of the specialty of brokers. And so to rewind just a little bit, if you're W-2, your income is pretty much straightforward. Whatever you have on your W-2, you pretty much get credit for, unless it's a one-off scenario where you have different deductions on your pay stub, whether you're paying alimony or child support, or you have a lien against you. Unless you have something as a deduction on your pay stub, you're going to get credit for that W-2 income. As 1099 or as anybody that's self-employed, you're going to have to get deducted anything that you write off in your taxes. So there's more ways that you could get credit for less income on a 1099. And that's kind of where we fall as brokers, and our specialty kind of being with self-employed. If a self-employed person were to go to, one of the bigger banks, we won't name names or anything, but they may not have a loan program for you. They might not have an option for you. It's like, oh, you claim this on your taxes, that's tough. Whereas if you can come to us, there is a lot of options. So Peter outlined a couple of them where you come in and you might have written off X, Y, and Z on your taxes, but that might not be the end all. We may be able to do a bank statement loan where we're looking at the cash flow, because you may have good cash flow coming up. I know one of my good friends is a barber. He can qualify for what he wants to on a bank statement loan, but if you dig deep into it and look at his tax returns, he writes a lot of stuff off, and so he wouldn't be able to qualify. So it's just kind of finding that loan program that worked for that person, finding the lender that works for that person, and then explaining the entire process to you. The other advantage that you get when you work with a broker is just that piece of personal service, that's there. I mean, Peter and I are both willing to just jump in the weeds and find a solution for you. So it may be a situation where you've been self-employed for, longer than 5 years. And so we might say, hey, you've done this for 5 years. The lenders can go off of only 1 year of your tax returns. So next year when you file taxes, why don't you make sure you claim X, Y, or Z amount? And we're not tax professionals. We can't give you tax advice, but if we say if you claim at least this much and don't write off, as of today, this is what you'd qualify for, and give you a good idea of. So again, like you may write off made $100,000, wrote off $80,000 for 5 straight years. But on that 6th year, if you're willing to pay a little bit more in taxes, you may be able to qualify for the house that you want. And then what you do after that is up to you, unless you want to refinance and need to qualify again. So there's always creative solutions if you don't need something immediately. But even if you do need something immediately and you come to a mortgage broker, there's going to be a solution for you. So I think that's the biggest thing is, it is a little bit harder to work with self-employed, but that's kind of what we specialize in.
And I'll just add one more comment to that, and that's great information, Nick. Thank you for that. Is, again, if we zoom out, this is where you want to work with someone who's there to advise you, not someone who's there to sell you. My old partner, Ida's old partner, Ali, he used to always say, we provide options, or we're not here to sell, we're here to provide options. And the whole mindset from our standpoint is to be educators and to help guide, not to just try to help stuff you into a loan that's going to benefit us, where we're going to make the most money, or it's just going to be the easiest possible for us. Because a lot of times, the easiest possible route for us is not the best route for you. And, if you're going to a big company, there's a lot of good loan officers at big companies, but there's also, we've all worked at, big companies or know people who have. We know how that goes. You hire, you fire a lot, you hire a lot. It's, here's our standard practice. The humanity of it is not always the greatest. And everybody has directives. If anybody's ever worked in sales, they know this month we got to close this many loans. We got to do this many things. We got to get at least 20% of our clients to get arms this month, because then the big boss is going to get a huge bonus and you guys are all going to get a pizza party type of thing. And at being a small company, like the reason Nick and I started this was not to have all those other influences. It would actually be a lot easier for us to go work at a big company. I had offers, like when we went to go start this, they had offers from companies to run their state of Minnesota for their company and do it. The reason we didn't do that is we didn't want to have those other influences. Now, again, it's not like we're the angels and everybody else is horrible, but there's a lot of good people in this industry, realtors, loan officers, but there's also a lot of people who are in it to make a lot of money because you can. And so you want to work with somebody who's going to put the time and the effort in to understand your situation. So you can fact check them, you can verify things. Transparency is huge, but you don't have to do all the legwork yourself. Because I always tell clients, a lot of times people want to call me, give me no information and say, favorite question, what's my rate? Nobody can tell you that. Nobody can. Some people will make it up. If they're a salesperson, they'll tell you the best possible rate and get you all excited. So you'll go engage with them and fill out the application and do everything. And then they'll sell you later on when it changes and it goes from 6.2% to 6.9% because they told you the best possible scenario. So again, like zooming out, make sure you're assessing the person you're working with, the company you're working with, their approach to things. And people have asked me before too, like, well, then how are you going to make money if that's really your focus? Like, it sounds too good to be true. Nick and I are not trying to make millions a year. We don't have shareholders that are demanding to see an increase in their share price every quarter by at least 4% or whatever it is, those type of things. We can make a living, a good living, helping people. And we like to think of it too, that we're actually doing some good in the world, not just doing this as a job, but doing this to help people. So, and I know Ida is the same way.
Well, yeah, for sure, Peter. And the whole thing of how we were raised and the type of people that we are, it's we want to be able to sleep at night. And if we were out here lying to people and ripping people off, we wouldn't be able to sleep at night. So we go to bed every night knowing that we were transparent, that we did good. There was a question in the chat from Effie, and he said, how competitive is the private bank interest rate? Do you want to just quickly touch on high level, don't get too into detail, QM versus non-QM, and why, if I get a conventional, first-time home buyer fixed rate loan, why the private bank is going to be a little bit higher, be non-QM?
Yeah, yep. So yeah, thanks for pointing that out. I missed that. So to keep it very high level and simple, again, if you want details, hit us up. I'll give you the full breakdown. You can spend an hour on this if you or more, or even just 5 minutes. But simple terms, the rates that we see advertised, the loans that we're usually talking about are conventional. A conventional loan is the private loan, and then FHA, USDA, VA. Those are government-backed loans that are available to the public. If you're not qualifying for those loans, like Ida's client, that's 1099. The other one that I talked about, where you can just bring a 1099 and it says 100,000, you get credit for 100,000. That's a private loan. So the ones again that we're all talking about, those have the best rates. Those are the easiest to qualify for if it works out for you. But in a free market, or quasi-free market that we have in the United States, there's banks and lenders saw there's still a need. There's a lot of people who actually make a lot of money and can afford these houses, but these loans don't work for them. And a lot of times it's self-employed individuals that this applies to. So the lenders, the banks, they created these loan products to say, all right, the risk factor is higher because clearly you would go for that other loan product if you could. It's not working out for you the way your finances are structured and your income structured and your debt and everything else. So we'll go ahead and create these other loan products that you can qualify for, but your risk factor is higher, so it's more likely that we're going to have issues getting you to pay probably. So we're going to charge you higher interest on it. Just like if Nick always pays his bills on time and he asks you to borrow $1,000, you're like, I know Nick's going to pay me back. You're not going to be worried about it. You're not going to charge him much interest because he always pays you back. If me, on the other hand, you borrow me money and then you got to chase me down and show up at my house at midnight to get paid, you're going to charge a lot of interest to lend me the money, because otherwise you're going to be like, the headache's not worth it. So it's the same thing with banks. Is they're like, okay, the prime example does not work for you, so we'll create these private solutions for you directly through us, not through these huge investor pools that dilute the risk, and then we'll give you an option. But again, it's going to cost you more. And that's those type of loans too. The credit score becomes a much bigger deal, even if you're a first-time home buyer, especially if you're a first-time home buyer. And also even the type of income you have, the way your income is structured, the way your debt is structured, it can get very complex. And if you're in that situation, it looks like he's joined the chat, so if he wants to add to this, he can. But if you're in that situation, then you want to make sure that you're working with somebody, again, who does this on a regular basis, because there's a lot of nuance that goes into it. And as loan officers, we need to both understand you and your situation and your priorities, and then on our side, understand the actual technical side of all the different loan products and which one is actually going to fit your priorities and still qualify for the loan that you want.
And then the other thing that I would mention as a factor to why the interest rates on the private loans are a little bit higher is, like, for example, like one of the main lenders we work with, like, they do loans very, very fast. They don't dig into a lot of these higher touch, harder loans. But what they do is they'll pretty quickly sell that loan off to a different company to service them. So more often than not, they're not retaining these loans for 30 years and servicing them for 30 years. They're keeping their cash flow. They're selling them. They're bundling those mortgages together and selling them to investors. With these non-QM loans, with these private lenders, these are ones that there's not the secondary market for them to sell. These are the ones that the higher percentage probability is they're going to be servicing them for the life of the loan, or they're a lot harder to sell, and the secondary market doesn't really exist for them. So that also drives up the interest rate and the price of the loan, because they're not able to just, I can just bundle these together and sell them to an investor and then have somebody else service this loan. And I think that really also drives the higher initial interest rate.
Yeah, it gets very complicated. But yeah, if you want to have him jump in, Ida, we can see what other questions he had, or if he wants to clarify it.
Perfect. Yeah. Salam, Effie. I hope I'm not pronouncing your name. Dicing it.
Salam. Yeah, you're saying it right, Effie.
Effie, okay.
Hi, everyone. Ida. Thank you very much, Ida. I've been following your Amharic sessions, but this is the first time I'm hearing an English session. It's really, I think, informative and I was actually learning, and I was commenting that I'm on right now on a very early preparation, I would say. Thinking 18 months. I don't know if it starts early for you guys or early for me. But yeah, I'm thinking 18 months from now to buy. But I'm learning a lot of decisions from Aida and her friends. And you guys are coming here also. That's great. So what areas I should be prepared right now? Early preparation, I believe, is very important. So is it my credit score? Is it my other than savings, right? Savings are definitely, that's my assignment. That's my homework. I wouldn't expect you guys to tell me to save. I have to save for the down payment. But what other areas I should be, getting ready so that when the time comes, at least I'm pretty much ready so that people like you, can easily connect me to the best interest rate and best deals.
Yeah, no. Thank you so much for joining, commenting, and engaging with these lives. That's huge for us, and honestly, that's what we want. We want people to be able to get value out of these and be helped. So thank you so much. And you're exactly in the perfect time frame. Like in a perfect world, we would want every client to reach out to us a year and a half in advance of them buying.
I think you might got a phone call. You back?
Is mine?
Yeah, you're paused. So if you guys can tap this.
I could hear him.
Okay, yeah, I could not. He just paused. So if you guys can tap the screen and share, copy link the page, it will help that he won't freeze like that. Please, 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 let's go, family.
So yeah, but I mean, we wish that every client would reach out to us a year and a half in advance. Then we can prepare you, and so you have a smooth transaction when it comes time to buy. So Peter, I'll let you answer his question, but I just wanted to jump in with that little blurb.
Yeah. So I usually tell people, and again, this will vary lender to lender and broker to broker. So we're very relationally driven. We're local to Minnesota. We're local to the Twin Cities. We might see you at the store 6 months or 6 years after you buy, type of thing. We're not this big conglomerate out of a call center. So all that to say, a lot of lenders, if you do call them 18 months ahead of time, they will tell you to call them back in 18 months because they're literally there to take your order, process your transaction, and then have a good life. Unless you need a refi, then they'll answer the phone. Anything else, good luck getting a hold of them. But like Nick said, we actually prefer when people come to us. If people ask us that question, we usually tell them 6 to 18 months. And ideally, the longer, the better, because we want to help prep you and get you ready. So if you're in Minnesota, we can help you. If you're not, we can help you find somebody out in whatever state you're in. But we would want to do usually what I'll tell people is if they're okay with filling out the application and sending us docs, we'll do a pre-approval, even though we know that you're not going to buy right now. And what that entails is looking at your income, your debt. That's one huge factor. The second one is your credit score. And the third one is the down payment, as you mentioned. So if all of those look good for what you want to do, then all you got to do is maintain. There's not going to be any differences you need to make. Just obviously, like let's say you want to buy a $500,000 house with a 5% down payment, and we do a pre-approval and we check everything and it looks good, then we're just going to say maintain it. And we're also going to remind you, don't go out and get a Escalade with a $1,500 a month payment, because that will change things. And a lot of times that will throw things off. So you still want to maintain. You can't just do whatever you want. We had a guy call us about 2 years ago that pretty much did that same thing. It was like a $1,200 truck payment, but he got the truck and then called us to buy the house the week after he bought the truck. And his approval went from about a $350,000 house down to like a $200,000 house, which he didn't end up doing anything. Still hasn't done anything to this day because of that truck payment. But getting back to this, if for some reason you're not in the optimal position, when we do the pre-approval, that's where we'll sit down with you and say like, okay, your credits, it might even qualify. You might have 650 credit. Usually you can qualify with a 650 credit score, depending on the situation. The talking point is at least 620. Technically, you can go down to 500, but there's context with each one. But ideally, in a perfect world, you want to be 800 or as close to 800. So if you got a year and a half, we could say, hey, it looks like you know about this. I had a client recently, they had a $70 collection that was dropping their credit score by 100 points. They didn't know about it. I think it was from T-Mobile or something like that. And I'm like, hey, call them, see if they'll remove it from your credit report or at least get it paid off. That'll help your score bounce overnight. And then over that 18 months too, the farther away you get from that, even if it stays on your credit, the less it will affect your credit score. So the same thing with income. Obviously income, we can't just change that overnight, but then looking at the debt side of it, we can even help you say, okay, how could we try to consolidate your debt or change your debt structure to be able to better qualify for the loan you want to? And same thing with down payment. There is a lot of down payment assistance out there, but most of them, I would say, best case are 0% loan. There are some exceptions to that, but most of them, the best case is a 0% loan, and you're still, you don't have that equity in the property. So if you put 5% down and you get a 5% down payment assistance, technically you have zero equity in the property, which isn't ideal either. So we look at it and say, okay, are you able to save up to hit 3% down or 5% down or whatever number you're trying to hit? And then also looking at monthly payment, what's that going to be? And obviously we won't know where the interest rates are in 18 months, but if we factor in all these other things and we say, okay, here's the 2 things you should work on, we can even touch base every month or every 3 months or every 6 months and see how it's going to be able to get you to that point. So in your situation, I would say whether it's with us or somebody else, I would probably go to a mortgage broker. Again, maybe lenders do this, but from what I hear, they not usually. They usually tell them, call me back in 18 months. Because like I said, at the end of the day, we all get paid when this closes. And so if I do a lot of work and I help you for the next year and it costs us $1,000 plus time, altogether it might cost us $2,000, and then you go work with a different lender. Now we just lost $2,000 and we got nothing to show for it. So that's why a lot of companies don't do that. But we take the gamble, we take the risk because again, we value that high touch relational aspect of it. So I'd find somebody like that where you are, whether it's us or somebody else, and then go through that process, have them do the full assessment, and then point out areas that you have to improve to qualify for what you want, areas that you could improve that would make your loan terms better, your interest rate better, like you were talking about, how do I get the optimal interest rate, and things like that. And tying it back to what Nick said is for self-employed or business owners, that type of thing, 18 months ahead of time, that does give us enough time for anybody that's self-employed to be able to say, okay, here's how, like Nick said, we're not tax preparers, we can't advise on that, but if you claim this type of income, this is what your approval would look like. We have clients like that every year that come to us and they're like, yep, we just filed taxes, want to buy a house, and they wrote off everything. So they made, one of them, the biggest example I had is a few years ago, I had a guy that made over $500,000 and he wrote off over $450,000. So his effective income was like a little over $50,000 for the year. And he wanted to buy an $800,000 house. Well, that's not going to happen on a less than $60,000 a year income. So he had a decision. Do I wait a year and file taxes differently? Do I try to refile taxes? Do I, and the fees that are involved with that? Or do I just buy a cheaper house? He decided to refile taxes, pay his CPA to go back through everything. It took a couple months. He had to pay all the filing fees again, pay more taxes. So again, if you come to somebody early, they can walk you through those steps and then again, set you up. But the biggest thing, the other thing, if you guys are interviewing loan officers, listen to them too, interview them too. Don't, because they're interviewing you, but a loan officer who talks to you and doesn't ask questions, usually they're just selling you whatever they have. If I only sell apples and you come to me and you say you're hungry, I'm going to convince you that apples are what you should buy because that's the only thing I have to give you. Or if that's just the easiest thing for me. If you really want to get what's the best meal for me, and I know all about diets and all that kind of thing, and I have a full spread, then I can be like, okay, based off what you told me in your health and your age and this and this and this, I think you should have this and this. And if it's roughly the same price you're paying everybody, why wouldn't you want to go to that person that knows all about diet and health and all those other things versus the one that's just like, yeah, I got some apples, here you go. Like, you're hungry, eat an apple. So yeah, that's probably as deep as I'll go on that. But yeah, and you should also work with someone. The other thing I should say, there are people that will charge you up front. My thing is, I would say try to work with somebody who's not going to charge you up front. Because all the good ones that I know personally are not going to charge you anything. They're gonna have good faith that you're going to be able to build a relationship and you're going to stick with them. And they're going to walk you through that whole process to the end, and they'll get paid when you get your house.
And the one exception to what Peter just said is if we refer you to like a decent credit repair person, that's the one time where if they're recommended by somebody else, they have good reviews, I would be willing to pay an upfront fee is somebody that is helping me with credit repair. The other thing that I'll say that Peter didn't mention regarding the 18-month timeline is no matter your type of income, there is an avenue towards getting that income level up. So if you're self-employed, it may be, hey, if you file this on your taxes, your income's going to go up. You pay a little higher taxes, whatever. If you're hourly, it's, hey, is there overtime available? Because you have 18 months to work overtime and have that, good trend setter to maybe get more income. If you're salaried, you can still ask for a raise when your annual review comes up. There's always options when it comes to it. So 18 months really gives us a chance to say, hey, what are you trying to do? Like you're talking about, like, get a good loan officer that interviews you, that listens to you, that says, hey, these are your goals. So I'm not just giving you the script that I give all of my clients. I'm saying, what is your specific goal? What is your specific situation? Okay, this is what you want. This is what you need to do. We have 18 months to do it. So that's what you want. Ida, you haven't talked in a while. What do you got for us?
No, I'm just like excited what you guys are answering, because this is exactly what we say to our clients. I have a client who actually called me from Virginia that been following me like Effie the past couple of years, but he just so scared to go on, stop processing, buying a property, right? So I think giving yourself a time. Don't go and like we get clients. They will call us, hey, my lease is going to be over in 90 days. I need to buy a house. I'm like, don't rush to purchase this big investment. You need to do your homework before. Hi, Daddy. Hi, Daddy. So all that kind of stuff, it needs to be aware of ahead of time. And for Effie, I so proud of you that you are taking your time, saving your money, building your credit. If you earn W-2s, you know how you can save your money. If you don't have 401k, get on a 401k, because some of you guys have 401k, but you don't use it for your down payment or closing costs, whatever that the loan officer will tell you what to do with those, and I don't know. So those are the stuff that you can do your homework ahead of time. Then you guys will be able to accomplish something. And when you work hard on it, you know that how deserving that thing is. You feel like you just own a trophy. So I am so proud of you. That's what I can tell you. I'm so proud of you. You're doing your homework and to get through what you wanted to get through. So question for you, Effie, where are you?
I was going to say, did we answer his question too? But yeah, go ahead.
That's what I wanted to ask him. One, where are you located? And second, most of the stuff that we just talked about here, it is actually in my, I'm going to mute you, Peter. There's a background stuff. So on my Gojo Realty YouTube account, a lot of videos that it is there, like, because you've been here almost every Sunday. If you miss any Sunday, I'll probably be missed it too. But there is so many information that I put in right now. What we are talking about, this thing, it is recorded in my YouTube account. Right now we are on YouTube and TikTok. So you guys not going to be missing out. If you guys came late, you go to Gojo Realty YouTube account, or if you can look for me, Ida, is that right? You can find this information out there. But with that said, Where are you located in the U.S.? Are you in the Virginia and Maryland area, or are you in the Midwest, West Coast? Where are you?
Oh yeah, I mean, you've answered a lot of questions. Since day one, Aida, and you, two of your friends here also have been answering the question. So I'm located in Texas.
Okay.
So I loved the interviewing the loan officer idea. I think not only them interviewing me or us. Mortgage broker. Actually, one thing I learned today, I was thinking of mortgage broker when I'm ready, which is like, when I am ready, not just now. So that's a good lesson, I would say, and that's also focusing on upfront, payments kind of mortgage officers. I'm also a service provider, so I understand what you mean. I think it makes sense that way. So just like, I don't want to take a lot of time from you guys, but adding some personal information about my status, my savings, and stuff like that. We took a car loan, like a financing. We financed our car. We just bought like 2 months before. But also the main goal of that car is building my credit, building, everything before the house loan process starts. So what I'm trying to do right now is paying for the interest at the same time paying for the principal. I know the last 2 months my credit score went all the way down because of the loan, but I'm sure in 2 or 3, 4 months it will go back again. So one confusion I had, I'm always listening to this TikTok live about loans and things like that, so I can learn. It's a process. I wouldn't learn in one night. So it's been only 1.5 years or so since I moved to the States. So Aida is one of the few, people listening every night, and I'm learning without reading the books. For real, it's been 1.5 years since I moved, but I'm learning a lot already. So do you think I should finish the car loan before applying for house loan? Or someone said, not Aida, but someone said, don't finish everything. Just at least keep like 1,000 or 2,000 or 3,000, of loan on the car before you apply for the house loan. And they said that would also help you, because closing a loan, closing a credit card would also, I don't know, take your credit card down or something like that. So right now I only have 3 credit cards. I'm still new, but still building it very nicely. The other one is, yes, for 1K, Aida. We're saving with my wife's 401k. She's saving a lot. I am not saving because I'm focusing more, on paying loans and things like that. But we're using her 401k. We're building a 401k. Also, how many tax returns, do the loan officer would consider? Like how many tax returns? Like 2 years of tax return, or 1 year of tax return, or 3 years? Because my situation is that I have full-time job. Like the W-2, the 1099, like the full-time job where you have all the taxes being cut by the government, by the employer.
W-2.
But also W-2, right?
Yeah.
Yeah. But also I have a side business, not a big one, a side business where I'm paying myself for 1099. So last year is the first time I did the tax return, because that's the first time I actually lived here. So my tax advisor, the one who does the tax thing, he did what you guys said already earlier. He tried his best, to make sure that my expenses are there, right? Yeah, exactly. That's what he did, Aida. So, but from what you're saying, of course, moving forward, maybe it's worth it, to keep it as it is, as much as it is, keep the income so that it can help me in the future. Because I have to choose either of those, or go to you guys and, go through the private banks. Either I get a tax return cut, or, I get a better interest rate at the end of the day. So how many tax returns do they see? Because I have, I think, 1 or 2 coming if I'm going to buy in 18 months. I know it's a lot of questions, a lot of maybe this might go into one-on-one session, things like that, but I'm happy. Today, finish our chest I can ask any question.
Don't look at how many people are like listening to us. Just I used to do this. I know. No, you're good. Yep. Perfect.
Thank you guys.
That is
actually appreciate it.
Yeah, that is actually a good question for a lot of us here. How many paycheck that do we need? And with the tax cuts, with the personal, the 1099, like me, I have 1099. Am I gonna use that self-employed income?
Yeah.
Those are the stuff that we need to discuss. And I will mute myself. Then you guys can go subject by subject. Then I can capture those videos that I can put them out on TikTok. So
I'll go quick, and then I'll kick it over to Peter. And first of all, Effie, thank you so much, and don't worry about taking up too much time. This is literally what we're here for. So this is good stuff. And then obviously, like I just say, and she can record this stuff. So the next time that someone has a similar question, we can say, actually, we already covered that. Here you go, and send them a little 3-minute video that kind of covers it. So first and foremost, with what you said, it really depends on the car loan with your situation. So that's why we would look at everything now and say, okay, this is what your income, this is how much your car loan is. You either need to pay this off or you don't need to pay this off before you buy a house, depending on the terms of the loan. Obviously, you want to make on-time payments. And then with your credit history, the more on-time payments you make and the further you get away from the loan, your credit score is going to go back up. With a car payment, if you're less than 10 payments or 10 payments or less, it's not going to count against you on the loan anyway, so it doesn't have to be paid all the way off. And I think you were getting a little bit confused because with credit cards, you definitely don't want to close accounts of credit. But if you were to have paid off like a car loan, it's not going to hurt your credit to have paid that off. But the more lines of credit that are open, the better. And you want to be able to use those lines, but you don't want to be using, say you have $1,000 available. You don't want to be using $800 every month and then making the minimum payment. You want to be able to, the utilization wants to be between, I usually tell them between 10 and 30%. I think it varies, but either 15% or 18% of your total credit limit is kind of like the sweet spot. But even if you did pay a credit card all the way off, you wouldn't want to close that line of credit because the more good credit history you have, the better. As far as multiple jobs and the tax return question, you need to have done each job for at least 2 years in order to use that income for qualification. So you need at least 2 years of self-employed. You need at least 2 years with your W-2 job to be able to use multiple sources of income. So if you have 5 years at one job and 3 months at the other, we can't use both. We need 2 years at each job to be able to use it. As far as tax returns go, we always ask for 2 years. If you have done the job for more than 5 years, we can sometimes use only 1 year, but we're going to ask for 2 years of tax return. And then as far as W-2 regular pay stub income, we're going to ask for a month worth of pay stubs and your last 2 years of W-2s. So that's just a quick answer, high level, and then I'll just let Peter get into any details or things that I missed.
So kind of like Nick was saying, to zoom out a little bit, you can, right now, as you're kind of saying, you're kind of guessing at what you need to do based off what you've been told. So, and what you've been watching the last year and a half and that kind of thing, which is fantastic because this means you have a working knowledge. I was talking to Nick yesterday about more of a niche loan product that we don't do very often. And he was going to call one of our lenders about it. And I'm like, hey, just go check this out quick because having this working knowledge is going to allow you to have a much better conversation about a lot more intelligent conversation to see if this is a good product for our client with this lender. So same thing for you. The more you learn as a client, the more you're going to be able to ask intelligent questions and kind of cut through either the salesiness of it or, as a loan officer, we can kind of jump to step 35 of the process with you because you've already kind of reviewed step 1 through 34. But looking at your debt to zoom out, loan approvals is one of the big factors is your debt versus your income. Now, depending on the loan type, depending on the lender, and also depending on your profile, that debt to income ratio, I've seen it as low as like 30% for higher risk people. I've seen it as high as 50, usually about 57 is about the highest you can go for a home purchase. Refinances right now, there's some products you can go up to 60%, possibly even 65 with some private lenders. So there's standard industry terms, like usually we tell people 45% debt to income ratio, but that's a very basic, broad number. And again, all this to highlight, going to a professional who can sit down and break it down for you is, again, based off your priorities, because it's going to be totally different if you're trying to take out a $500,000 loan versus taking out a $300,000 loan. I don't know I think you mentioned you have a wife. It depends if you're going to add her to the loan, or is she working or not, or how that would come into play too. Or you guys end up with both you on the loan or one of you on the loan. So usually when clients come to us, like I started to talk about earlier, they'll call us and say, what's my rate? What are the rates at today? That, like I said, everybody's rate's different at all times. Rates can change all the time. We have a live tracker. They're always changing. But we can distill it for you and figure out, here's your best 3 options, and here's the best ways to hit those based off what you told us your priority is. If the lowest monthly payment option is the best option for you, then you might be paying more over the life of the loan. But if that's what's important for you in your situation, that's how we're going to structure it. And that's how most loan officers by default will. But if lowest amount of cash to close, to spend on the transaction is your biggest priority, we might do it a little bit different. Or if least amount of interest paid is the most important thing to you and you can make it work, like a 15-year loan, 15-year loans usually get about 0.5% better rate than a 30-year loan, but the payment is significantly higher. So we could look at that. And if, just making up numbers, but if you make $50,000 a month and you're taking out a loan and you're looking at a 30-year and a 15-year, the difference in the payment is probably not going to be enough to negatively affect you, where you're going to want to do the 30-year. You're probably going to want to do the 15 because you're going to pay a lot less in interest because you have that income to be able to do that. You have the ability to do that. Somebody who comes to us and it's a couple and they both make $20 an hour, we're not going to be looking at a 15-year loan. So again, when clients call us and ask us those questions, I always tell them, well, we can kind of spitball this right now, but I'm guessing too, because sometimes clients as well, they are well-intended, obviously, because they're talking about their own finances, but they might tell us the wrong information or make it sound in a way, communication can have static. So it doesn't matter whose fault it is, but there can be misinterpretations. Numbers are hard numbers. A 2 cannot be a 3 and a 10 cannot be a 5. So when we see those numbers on credit and income and debt and all those things, that helps us structure everything, kind of like Nick was saying. But your priorities are the biggest thing, because you and Ida could have exactly the same credit score, income, debt, down payment, everything, but have completely opposite priorities and how you want to go about it. So we're going to give you very different answers based off of those priorities. And again, though, if it, you talk to your friend and you're like, well, my friend this, and we're similar, like what? Well, we should be able to sit down and answer those questions for you, not just get offended or get mad. Because again, zooming out, this is a sales job. And if we can help 10 clients a day, and, again, just making up numbers, but if you help 10 clients a day and you make $100 off each client, you make $1,000. If you only help 1 client, you make $100. So especially from a business standpoint, you want to help as many people as possible. So sometimes we get into this order taking mindset of like, all right, let's get on to the next one right away. And that's where you got to advocate for yourself if that's starting to happen. And if it happens a lot, maybe find a better loan officer who's going to take the time for you. But yeah, getting back to everything though, like the car payments, like Nick was saying, we can usually exclude it. And to clarify for you and anybody else, I know you said you bought it, but like leases, we cannot exclude it because that's a lease. At the end of that lease, there has to be a decision. We don't know if you're going to buy the car, are you going to give it back, what's going to go on. So if you have 8 payments left on your lease, we still have to include it. But if it's an installment loan and you purchase the car, now we should be able to exclude it. You also have to have things like on-time payments, things like that. But again, we're speaking in general terms. But yes, if you get it under 10 payments, we can exclude it, like Nick said. And installment loans are very good for credit long term. Late payments can really hurt your credit. And then, like Nick was saying, with credit cards, the perfect place to be, the credit teams tell us, is 0 to 10% in your balance, but at least under 30% of total utilization. So just explain that really quick. If you said you have 3 credit cards. So let's say the balance or the limit on one is 1,000, another is 5,000, another is 10,000. So 16,000 total, 1 plus 5 plus 6. You have 16,000 available to you. The things that influence this, one is how long they've been open, length of history. Because that, from a bank's perspective or a creditor's perspective, if you had a credit card, like I've had one of my credit cards I got when I was 18. So that one's been open for a long time, almost 20 years. That one looks really good. And I don't think I've had any late payments on that card ever. So that looks really good. It's been open a long time. It was a college credit card. They will never raise the limit. So it's stuck at $5,000, but it still helps me. The biggest thing that helps me with is the length of history. Okay. So that's huge. And again, if you've only been in the US for a year and a half, totally fine, understandable. You can't change that. But the longer you have those open, the better influence that will have on your credit score. So we always tell people, even if you don't need them, use them every 2 months, spend at least 10 to 20 bucks on them, make sure it reports to the credit agencies, and then you can go pay it off. But getting back to like that total balance, like if you're 1, 5, and 10 or a total limit, so you have 16,000 available. When Nick was talking about utilization or that 0 to 10% or even 0 to 30% sweet spot, it's not like if you maxed out the $1,000 credit card and then didn't have any debt on the 5 or the 10, the creditors and the credit bureaus look at it as they add all of them together. So you don't need to be at 10% or less on each card. You need to be at 10% or less on that 16,000. So even though you have 1,000 on one and 0 on the other two, that 1,000 being maxed out shouldn't really hurt you. If you go over your limit, that could hurt you just because you're kind of going over where you're supposed to. Usually that happens with like interest or you missed a payment or something. But in general terms, they're going to add the limits together of all of them and then add the balances together. And that's how we get the utilization rate. So credit history, utilization rate are both huge things when it comes to credit cards. And if you do have high credit card balances, paying those down is usually the fastest way to get a credit boost. So if you have a $100,000 car payment or a $100,000 car loan, you got a really fancy car, and you go pay that down $50,000, you're not going to see much of an increase in your credit, to be honest. If you have $100,000 in credit card debt and you go pay down $50,000, you're going to see a pretty significant increase in your credit score usually. Now, again, everything on your credit report comes into play as well. So if somebody that doesn't have, good example, client came to me last fall, 597 credit, which usually sounds like, it's not great. Anytime you're in the 5s, that's not good. She's an immigrant. She's younger. She was just graduated college. She didn't have a lot of credit history. She had 2 credit cards. They were both maxed out, but they were only, I think one was 1,000 and one was 3,000 or near maxed out. It was about 90% utilization. She got denied. She had went to multiple lenders. She was super depressed. She had just got out of college, got a really good job, making over $100,000 a year. Thought she was going to be able to buy the house that she wanted. No debt except for those 2 credit cards. The combined payment on it was like $200 a month or something. And again, she's making over $9,000 a month. So she's thinking, all right, I'm good, but why is my credit score horrible? None of the lenders or loan officers she talked to explained to her to help pay those down. Now that's a pretty simple one as a loan officer, so I'm pretty shocked that nobody told her that. But for us, I looked at it, I'm like, how hard would it be for you to pay this down? Looking at her income, she's like, I can pay them off tomorrow. But nobody had ever explained this to her. It was a 30-second conversation. And I'm picking an easy one. But that's where like some things, it might just take 30 seconds of talking to somebody. The other one, it might be more involved where they say, okay, here, we got to come up with a plan because we can't do this overnight. Yeah. But her credit score went from 597 to 660 in a month. And we could qualify her. She bought her house in January and she's super happy about it. nobody else, like I said, for 5 months before that, every other lender just denied her. So it can be that simple. If you have a lot of collections and things like that, Nick was mentioning earlier, and it sounds like you probably don't, but for anybody listening, that's where, if it's simple, we'll help you. If it's more involved, we will refer you. Again, we don't do kickbacks. We don't have any agreements. Even with IDA, we don't pay each other on the side or do anything crazy like that. That's all very illegal. If you ever work with anybody like that, run away, because they should not be doing that. But we would, if it's outside of our depth, because we're not an expert, we have our niche that we're good at, then we're going to refer you. And there's one company we've started working with the last couple of years that they seem to be really good. They seem to be honest. And also they're not a credit builder that will string you along and try to keep you paying them for 3 years. Their goal is 6 months or less, and they work in all 50 states. So if anybody wants a referral to them, again, we don't get anything out of it. We just try to find other good people and other good companies that if somebody's looking for help, we can say, all right, go here, because there are a lot of credit builders that will either charge you huge fees up front, and they might do a good job. I know a couple that, both of them don't do it anymore, but they charge about $2,000 up front, and they would get your credit up and they will help you a lot, but they were very expensive. Yeah. And then there's the other side of it. It's these other companies that'll charge you $50 a month till the end of time, and your credit will go up 10 points in 3 years. So again, if anybody needs something like that, we can help with that too. But yeah, paying off credit card balances is usually, in a simple terms, in the process, and Ida knows this because I've been telling her this all summer, but we're getting very close. We have a meeting today at 1:00, not Nick and I, one of our coworkers, to go over this. We've already talked about it. We've been setting this up for a while, but we're going to start generating a lot more content on our social media pages. We'll post it on our TikTok pages, so you guys can even come back here too. Obviously, you can always ask us questions, but you can even go on the page and say, like, okay, what matters about credit again? What matters about this? Why is this important? And you should be able to find all those things. So if you're, some of our clients tell me, yeah, it's 1:00 on Saturday night and I'm laying in bed and looking at this stuff and I didn't want to call you. Well, then now you can go pull it up and see it. So, but yeah, long story short, I would reach out again to a professional, not sound like a broken record, because even paying that car down, that sounds good. And in general terms, it is. But I've had clients tell me, like, oh, I just went and paid off a $10,000 car balance. And I'm like, shoot. If you would have came and talked to us before you did that, if you would have actually put that 10 grand towards your credit card debt and got your credit cards paid down to zero, you would have you'll see a much bigger increase. Or you didn't need to pay off that car. You actually need that towards your down payment because you're getting a bigger house and you need a certain amount for the down payment, and now you're a little short. So now we got to save for that. So I know I've been talking for a while, but yeah, if you talk to them, they can help guide you. If you're in Texas, if you need somebody, let us know. I know Ida knows people as well, so she might be able to connect you with somebody. But yeah, that's how I'd approach it. I wouldn't spend any money till you talk to somebody, have them do an assessment based off your priorities, and then they can tell you, especially if you have a chunk of money, to say, okay, here's where I would spend that money.
Yeah. No, and the last thing I'll touch on with credit, because it's important and there's misconceptions around. And obviously everybody wants good credit, and it does a lot of things for you in life, and especially when it comes to mortgages. But in the realm that we walk, you want credit, right? No credit is worse than bad credit. Yes. And so we don't want to confuse people. You want to use your credit cards, then pay them off. It's not a bad thing to have a car loan. It just depends on the payment and if you can still qualify. But credit is a good thing, and you want as many sources of credit as you have. You want open lines of credit and as much good credit history as you can have. So we don't want to scare you off. Like, credit is a very good thing. Don't go close credit cards or anything like that. Use your credit cards, especially for online purchases. Protect yourselves. Don't use your debit card. But you definitely want those 3 lines of credit. You definitely want that car payment. Like, those are good things. We just need to take a look at it and help you with qualification purposes.
Yep. Perfect. Thank you. That's good detailed stuff. I hope Effie is taking the notes. Any question for you, my dear, before we close our house? We passed 8 minutes already. Effie, do you have any more question?
No, thank you very much. But it's very much informative, and thank you. Reach out. Yeah, I know. Like, I can start where I know where I can start right now. You know, what kind of people to talk and where to start. And the credit card is also a good insight. Yeah, it was a great session. Thank you, guys.
Perfect. Thank you. Thank you so much for coming. We really appreciate you. Come and ask question anytime. You know, it does not matter if we have 20 people are on the stage or one person. I want everyone to come on the stage and ask question or write on the comment if you guys don't want it to do that. It help a lot because any question that you have in your mind, if you don't spit it out here, there might be more people that who's sitting with that question. So nobody's answering that for them. So I would like you to engaged and all that kind of stuff. Go ahead, Peter.
I was just going to say, yeah. And for anybody else listening, like this, I think is the most valuable use of this type of time too. Obviously we want to teach you guys, but nothing teaches more than real life examples. And the other like side piece to that is both on the real estate side, us on the lending side. We run into it a lot where people get advice from family and friends, and that's great. We're not trying to manipulate you and say, like take you away from them and tell you not to trust them. But there's a lot of confusion on these topics. Also, like on the lending side, things change all the time. Even on real estate, they change all the time. So a lot of times that we run into issues where somebody got advice from their brother or their best friend or their girlfriend's dad, and it's not accurate. And so we got to help explain that to you, but and establish that trust and everything else. But that's why you want to go to a professional that you can trust and that is knowledgeable and all those things. And again, you can verify things, because if you listen when you talk to people, usually if you pay attention, and even with social media these days, and look at what they post and and how they're explaining things, you can tell if they're being honest with you, especially the longer you talk to them, or if they're just trying to sell you. And that's where, again, going to somebody you trust, but then say, hey, my brother told me this, or my brother brought up a good question. Ida and I had a client recently, and Nick worked with her a little bit too, saying she researched everything. She'd come up with a lot of questions. Sometimes I could tell she was reading something that somebody wrote down, or she wrote down, or maybe she read it off the internet. But it was great because then that gave us a chance to answer that. We don't want you to hold that in and then be worried that this or that, or again, go to the wrong source, because even Google and everything else, those answers on there, like I've been talking about this whole time, and hopefully have pointed out, the context of the situation, the context of your situation is what makes this whole thing work. And so without that, the answer could be wrong. So yes, listen to other people, whatever, but bring it to us and be like, hey, this came up. Help me understand this. Why aren't we doing this? Or why are we doing this? And that type of thing. So yeah.
Perfect. Thank you so much. I really appreciate you guys for your time, for your explanation, for your, ongoing helping the community. We really appreciate you guys. So right now it's 11:12 p.m. I have a walkthrough for our closing tomorrow, and I need to run myself. But I just wanted to say thank you. As you guys know, every Wednesday we are here from around 9:10, 9:15. It depends how many people tap the screen, and the screen not to freeze and all that kind of stuff. So if we can get that by 10:15, we'll get on until like 11:10. Every Sunday I am on, unless if I have a soccer game or holiday, whatever. I did not get in there last week because it was a holiday. It was Ethiopian New Year and this and that. So I'm here every Sunday, at least around like 6:30 in Midwest time. And, anything and everything that you need, we are here to help you. If we don't know, we will send you to someone who is expert in that kind of area. Anything that we talked here, I would like you to take a note and research about it. We are here to tell you with experience what we do on a daily basis. But I need you to do your own research to get in this rhythm for you to do your investment. Okay. With that said, I'm going to start with Peter, Nick, and then I will wrap it up and close our day session. And thank you so much for you guys coming and doing what you guys have done for us.
Thank you everybody for joining. Always come, ask questions. My name is Peter Jerf with Custom Made Mortgages based out of Minnesota here. And have a wonderful week, and we will see you here next week. And I think we're going to start trying to advertise this a little bit more, just to let you know ahead of time what we're going to talk about. So we're going to do a few things that just hopefully spruce this up a little bit and make it even better for you guys. And I will pass it on to Nick. Have a great day.
Thank you, Peter. Once again, my name is Nick Jerf, Custom Made Mortgages, located in the state of Minnesota. And the last thing I'll say regarding all this is, give us your feedback, ask questions, send a DM to our company account, to Peter, to Ida, what you'd like us to talk about. We are here for you. And just keep in mind, this is all about you. Effie is in Texas. We are all licensed in Minnesota. We're never going to do his loan unless he moves here. But that's fine, because we're here to educate and help the community, not just make as much money as we can. And the last thing I'll say is be empowered as home buyers, as homeowners, as prospective home buyers. We work for you. Your loan officer works for you. Your realtor works for you. And just realize that you can ask questions. You can push back on things. You can say, hey, I want this. I don't want this. And just keep in mind that this is all about you, and we will work for you tirelessly. So I'll kick it back over to Ida. Again, thank you all for joining, and please, let us know what you want us to talk about, what you have questions on. So Ida, take us away.
Thank you. That is a good conclusion. We are here for you. Unless if you are not closing the deal, we are not going to get paid. Most of us as a real estate agent, until you satisfy the property that I'm showing you that you're trying to invest on. If you do not purchase that property, that real estate agent will not get what? Their compensation, our paycheck, right? So with that said, I really appreciate you guys, people that who've been tapping the screen and share. I'm glad that Effie came today, because he did not know that we do these things every Wednesday. Unless if you guys were not tapping the screen or sharing the site, no one will know about this information. So in order for us to be successful and learn and what we need to do, the phone is on your hand. You just tap the screen and copy linking it, and then we all can learn and be happy. So with that said, my name is Ida Tezara. I am a licensed real estate agent in the state of Minnesota. I do commercial and residential, plus I am a team lead. In addition, that I've been doing is I manage properties as well. So if you are any state, does not have to be in Minnesota. If you need any of our help finding a lender for you guys, or if you looking for a real estate agent, you already pre-approved with your bank, whomever that you got pre-approved, but you need help to interview the agent that you wanted to work with, or if you want me to help you to pick, I am partnering with a lot of agents, a lot of different states. So I have a questionnaire that what you're going to ask for your hiring agent that you wanted to hire, and I can help you. I can be on the call with you, or you can pick your agent, then you can go from there. So with that said, thank you so much, and I hope we'll see you this coming Sunday, and we'll talk about a lot of different aspects. And if you have any question, please bring your question. And if you have not followed us, go ahead and follow us then we can go from there. And thank you so much. I will see you guys in a few because we have a closing tomorrow. Thank you. Perfect. I will